Happy Monday, everybody. Today is January 5th, 2026, and this is your first Monday market update of the year. A huge Happy New Year from our whole team. As we closed out 2025 and stepped into the first trading days of 2026, markets did not deliver fireworks. Instead, they delivered something more useful: perspective. Now, after three strong years of returns, the market is pausing, rotating, and reassessing. That's not weakness, that's digestion. And it's exactly the kind of environment where discipline, the theme we talked about in last Friday's planning video, matters most. Let's walk through last week. Early in the week, markets opened quietly as holiday thin trading desks returned. Stocks drifted higher to start the week, supported by steady economic data and lingering optimism around AI. Growth remains stable, not booming, not breaking, reinforcing one of the key pillars of this market: a resilient, if unspectacular, economy. AI leadership showed up again, but in a more selective way. Semiconductors and infrastructure-related names led, rather than broad-based tech, a sign that the AI story may just be maturing. The Dow closed up roughly 0.5%, S&P up 0.75%, and the Nasdaq up just over 1%. As the week progressed, momentum slowed and markets began to churn. Midweek trading reflected a reassessment of rate expectations. Stronger labor data pushed Treasury yields higher and reminded investors that rate cuts are not on a fixed schedule. That pressure showed up most clearly in high multiple growth stocks, while value-oriented and cyclical areas held up better. This wasn't panic, it was rotation. And this matters as we enter into 2026, because valuation is no longer cheap. With the S&P 500 trading nearly 22 times forward earnings, fundamentals matter more and multiple expansion gets harder. The Dow down about 0.1%, S&P down roughly 0.25%, and the Nasdaq down about 0.5%. On the final trading day of 2025, markets moved sideways. Despite three strong years of return, sentiment remained surprisingly balanced. Investors were not euphoric and fear was muted. A healthy backdrop headed into a new year. Geopolitical noise and policy uncertainty lingered in the background, but markets largely absorbed it without disruption. The Dow was down about 0.25%, S&P flat on the day, and the Nasdaq down roughly 0.5%. Markets were of course closed on New Year's Day. Then on the first trading session of 2026, it brought a measured reset. New Year opened with modest gains early, led again by semiconductors and select small cap stocks, a potential sign of leadership broadening beyond those largest names. But strong jobless claims data did push yields higher late in the session, and stocks gave back some ground. Importantly, there was no technical damage, just a reminder that 2026 may demand some patience. The Dow closed down 0.2%, S&P down roughly 0.75%, the Nasdaq was down just under 1%. For that holiday shortened week, the Dow was down about 0.2%, S&P down roughly 1%, and the Nasdaq was down about 1.5%. Quiet on the surface, but important details underneath. As we begin 2026, all four pillars supporting this market from 2024 and 2025 remain in place. AI enthusiasm, still powerful, but moving from promise to proof stage. Stable economic growth, intact, though the labor market bears some watching. Rate cuts, possible, but no longer guaranteed or imminent. Policy and tariff clarity, holding for now, but not risk-free. None of these pillars is as easy as it was a year ago, and that's often how longer market cycles mature rather than end. This week brings the first real test of the new year, and the focus is squarely on the labor market. Key events include ISM manufacturing and services data, ADP private payrolls, JOLTS job openings, weekly jobless claims, and Friday's December employment report. Consensus expectation point to a modest job growth and a steady unemployment rate, which will reinforce the idea of a cooling but not collapsing labor market. Why does this matter? Because the labor market is now the swing variable for rates. A gradual cooling keeps the door open for future Fed cuts. A reacceleration pushes rates higher and raises the bar for equities, especially with valuations already elevated. This also comes at a time of growing policy uncertainty. A new Fed chair later this year, midterm elections on the horizon, ongoing geopolitical risk, and the possibility of another government funding showdown later this month. In other words, data matters again. Wall Street forecasts for 2026 are all over the map, and that wide dispersion tells you everything you need to know about the year ahead. Uncertainty is not a flaw of the market, it's a feature, which brings us back to some of the past Friday planning videos. Plans don't work because markets cooperate. They work because investors stay disciplined when they don't cooperate. All four pillars are still standing. They're just being tested. Stay focused on your plan, not the noise. We're going to keep watching the data, the trends, and the risks, and help you navigate whatever comes next. Have a great week.